So, today, move on. Chapter 7. Mortgage markets. It gets close to the very end. Very tricky, very difficult, very complicated. We'll try to, well, we can't, but try to keep it as simple as possible. All right. Section 1, mortgages and mortgage-backed securities overview. Number 1. Mortgage. Mortgage has two completely different meanings, very different, very unrelated meanings. The first meaning is a loan. Again, up it goes, don't get in trouble, okay? A loan secured by real estate or secured with real estate. We also said we use the word collateralized with real estate. And mortgage, the second meaning of mortgage is a collateral used in a mortgage loan, okay? So, mortgage is a little bit confusing. The word collateral has only one meaning. It cannot have 2, 3, or 5 meanings. So the word collateral is the one word that you can always use without ever any confusion. Now, mortgages, very confusing word. The way not to have a confusion is to say mortgage loan. When you say mortgage loan, it means only one thing. A loan secured by real estate collateral, or with a mortgage, which is the collateral. Now here, mortgage as a collateral must be always only real estate, nothing else. Now in the textbook, they give the popular definition, popular. The popular definition doesn't mean it's correct, it's not true, but most people like to think it like that. That mortgage means a loan to purchase real estate. That's incorrect, okay? Now, let me try to provide a little example with a mortgage. You have your house A, that's house A. You own the house, which is called, let's use another brand new word for you, free and clear. Free and clear. Free and clear in finance, in law, means that you do not owe any money on the house. Means there is no mortgage on the house, there is no debt, and clear title means that nobody else has any claim on the house for any reason. Now, somebody may have a claim on a house like, let's say in the West, I don't know the law here, husband and wife, they get married, they buy a house, and then in the West they get divorced, and then the husband keeps the house, but the wife claims part of the house. So the husband doesn't have a clear title, okay? That title can get a lot dirtier in the West, let's say in my home country, and I'm not saying because I don't know your laws over here. Let's say we got big problems in my family because my dad and mom, gotta give, we got 2 properties, but they don't clarify which property goes to my brother and which property goes to me. And when they give the one property to my brother, it doesn't mean if they did not give me legally the property, doesn't mean that I am the owner. So I don't own the other property clear. My brother has a genuine claim. Okay? So I can't just easily sell the house even if I want, simply because my brother has a claim, because the house wasn't really given to me and only to me. In other words, when you have inheritance, sometimes brothers and cousins can get in the game. When you have divorces, can get in the game. Other type of clear title is there is a bank. The bank gave you money, you paid back the bank, okay? So the bank doesn't have a claim, but the documents aren't clear. You don't have all the documents proper. So for some reason, problems occur. Now here, based on your history of whatever, 20 years ago, maybe you have a lot of unclear titles. It's not clear who owns the land or the house or what happened during divorces, and maybe someone was dead and then, thought to be dead and then alive. So all of these problems are here. So back to the popular definition. You have the house, it's free and clear. You own it, you don't own anything else, and now you go and buy a house B, and here's the trick, with a mortgage on A, okay? So you take a mortgage loan on house A to buy a house B. So you take a mortgage loan, the mortgage loan is secured with A, you buy house B, and now there is a mortgage here, and this is free and clear. You took a mortgage, let's say $50,000 here. Now this one is a mortgage, and this house is free and clear, okay? And you purchased this one. So, did you get a mortgage loan? Yes, okay. And did you get a mortgage loan on A? Yes, but you purchased B, okay? Now, according to this definition, you use the loan to purchase B, meaning the following. You take a loan mortgage by B to purchase B, but that's not true, okay? Now what you can do is you mortgage B to buy C, okay? And then you mortgage C to buy D. And that's what people do do people do these things here or not? Not yet, huh? And that's what people do in a real estate bubble. When people go crazy, they start borrowing on their houses to buy more houses. When the price of houses goes down, they'll go bankrupt. Anyway, that's the clarification. All right, so you got a number of mortgages. Number one, home mortgage. Home mortgage is a very unclear word. Of course, everybody thinks and understands it means a mortgage to buy a home. Now, home is unclear. We don't know exactly what it means, home, okay? Home in English means a place where you live, okay? But, well, what about home mortgage? You own one home, you take a mortgage to buy another one. But you still live in your own first home, so the second one is not a home, okay? You understand? You can't have two homes, okay? I mean, you have one home and the other one is just a place where you can live. So here we got to change the word to mean something very different. It's called properly. The correct, good, proper word in English is residential mortgage. Residential mortgage is a mortgage to buy a residence. Residence is defined as a place where people can live and can sleep. The difference is that you may own 5 residences, but you have only one home. Home is defined as the one main residence that you would usually live. So you get residential mortgages. These are to buy apartments, condos, houses, in general a place where people will live and sleep, okay? So that's number one. Number two, commercial. Commercial mortgage. That will be for things like an office. Offices, okay? So an office is a place where people work but don't live. Now it's a little trickier, but you can extend the commercial mortgage to also mean for a parking. You know, that will be very popular here, but anywhere in the world, will be parking, and every time for 2 hours or for 1 day you charge money, okay? You make profit out of it, okay? So commercial will be for examples, office. The next big one is malls, shopping malls. Shopping malls. Another big one will be different types of shops, like a car repair shop, auto shop, motorcycle shop, where they do work, okay? They fix the motorcycle, but you can't just live there. I mean, you don't have all the facilities to live a normal life where you can just sleep and live and everything else. So all sorts of shops. Okay, so this is commercial. Parking. And garage. These are all commercial, okay? Commercial and respectively commercial mortgage. Okay, so commercial mortgage will be a mortgage secured with, we call it now a new definition, commercial real estate. Commercial real estate. The previous one becomes residential real estate. So the strict definition, residential mortgage is a mortgage collateralized, okay, or secured by, for residential real estate. Commercial mortgage is a mortgage secured with commercial real estate, okay. Here, another very nice commercial real estate will be, is this my phone? Maybe I gotta turn it on. No, mine is off. Hotel, motel, okay. That's, again, all real estate. And let's see what else we got. The next one is farm. Well, I need to put it in red color. Farm mortgage. A farm mortgage is a mortgage secured with farm real estate or farm land. Well, now there's a difference between farm land and farm real estate, okay? Farm land is just that, land used for farming purposes. But farm real estate will include land and buildings used for farming purposes. Building could be storage, you could keep their pigs or chickens. So the farm real estate will be real estate suitable for living of animals, but not suitable living for humans. Okay, these are simple things. Yeah, very good for chickens, right? Or for pigs. And it's a good place to live for pigs, but not for humans, right? So that will be farm real estate, okay? All right, let's move on. Now there's one other very tricky definition. That's the most confusing definition, is single family home. Single family becomes home and single family mortgage. And the other one will be multifamily. Family home and mortgage. This is tricky. Single family home is a home where you can have up to 4 places. So it could be a house with or 4 separate houses next to each other. So a single family home will qualify from 1 to 4 places. For example, you have in English, in Bulgaria, very common, it's called a twin house. A twin house is one house attached to another house. The 2 houses are perfectly symmetrical, they look the same, they look just like one big house, but they're actually 2 very separate houses. Of course, they have a common wall, okay? So that's very common in my home country, Bulgaria, okay? And that will be a single family home, okay? Even though they're technically 2 houses, okay? Same thing with apartments. You may have 2 apartments, they're next to each other, but if they're, again, the tricky part is that they have to be next to each other, okay? They have to be on the same land, they have to be on the same plot. Up to 4 of them is called a single family. To be multifamily, they must be 5 or more. That's a legal definition which is used in finance. So it may be confusing why a single family will be 3, but that's the way the world works, okay? Even in a country like Bulgaria, okay? Next, let's see what else we got. Oh, we got some other part which is getting very difficult. Securitize. To securitize means to create a new security. To create a new security. And securitization is the process of creating new securities, usually, not always, usually out of old securities. Okay, the one characteristic, well, there are many characteristics now about mortgage loan. First, not standard size. The mortgage size, meaning the dollar amount on the loan, could be $5,000, $7,000, $7,240, could be $20,000, $50,000, $100,000, is the amount of money that the borrower needs. Okay, it could be $12,740. Okay, so in the bond, you got standard amounts, and the standard amounts are round and beautiful. $1,000 or $100,000 or $1 million. Some of these money market instruments will have the round number of 10 million. Here could be any kind of number. Here you will have 40 different borrowers, and each will have a different mortgage size. The number will be, oh, minus 20,000, oh, minus 21,000, oh, minus 27,000, okay? So everybody's got his own different size. There will be no standardized terms. It means that, oh, my mortgage is 5 years old and yours is 20, and hers is 15, and someone else is 30. And when things got in Japan very, very crazy in the real estate, mortgages were for 50 years. So period of time would be 50 years. And then the Japanese proved to be the most insane people in the world, and they had the craziest of all real estate bubbles in the history of the world. They created 100-year mortgages, okay? We call this in the West child abuse. You know what's a child abuse? You get to beat your child kind of like to sickness. Well, that's what the Japanese did. They signed a mortgage for 100 years. So when the Japanese supposedly dies, he will give, the child will not get a house. He will get a mortgage where the child will pay until the child dies. And when the child dies, the grandchild will inherit the mortgage, right? In the West, we give to the child a house. Here's a house for you. In Japan, they give you the mortgage. Now, that's insane. But they did it, okay? So, the terms could be 5-year mortgage, 10-year mortgage, whatever. Let's see what else we got. Okay, now we got a new term here. It's called primary mortgage. It's actually a very straightforward definition. Is a mortgage on the primary market. Anyone remember what's a primary market from the chapter?
Primary market is the market that share after issued to the market.
No. Where funds are raised. Remember, here there is no share. Okay. So, where securities are issued and or, here's the key, in the primary market, funds are raised, okay? So, here you get money for mortgage. So, the primary market, you issue stock, you issue bond, you issue any kind of money market instrument out of the 6 instruments, or you issue a mortgage. In other words, in the primary market, you get money in, meaning raise funds, in return for a security. Here, the security is a mortgage. So, the primary mortgage will mean that somebody borrows the money and he uses the money to buy real estate, usually. Okay? That's a primary mortgage, okay? Then a secondary mortgage will be you take the primary mortgage and you do things with it, usually securitize. So you take primary mortgage, this is the original mortgage used to secure the real estate, and then you securitize. Securitize means maybe you'll take 100 mortgages, you put them together, and these 100 mortgages will make a brand new security. Maybe the new security will be, but not necessarily, let's try this one, a mortgage bond. Is a bond secured with mortgages. And when we say mortgages, again, mortgage is very unclear word. We say secured with mortgage loans. Okay? So mortgage bond is a bond secured with mortgage loans. Now, the mortgage loans will be secured with real estate. Okay? Let's see what else we got. Mortgages very commonly will be, the borrowers will be individuals or families. So each individual will have their own income, their own wealth, and all the other things. So there is no standard size, there is no standard terms. That's what the problem with mortgages. Every individual is separate and different. And then every property is separate and different. It's in a different neighborhood, different house, different size, different everything. So we say, it's a general term, not a financial term, that mortgages are highly customized. Highly customized. Customized to the borrower and customized to the property, customized to the size, to the terms, to the everything. So mortgages aren't quite standard. The extreme opposite of the mortgage, where things are highly standardized, will be government T-bills or government T-bonds. They're exactly the same size, they expire or mature on various particular dates, they got fixed interest rates, the interest rates are paid twice a year, so everything in the government mortgage market is highly standardized. Here it's the extreme opposite. Let's see what else we got. All right. Section number 2. Or 2, let me see, yes. So, securitize, let me finish this part here. When you securitize, maybe you gotta move a little bit, you get what is called mortgage-backed securities. Mortgage-backed securities. So, when you get primary mortgages, the result of securitization is a mortgage-backed securities. And mortgage-backed securities is security secured by mortgages, okay? Well, this mortgage, one example of a mortgage-backed security is a mortgage bond, but there are others which I'll be coming hopefully next time. All right, primary mortgage market. Let's move on. And I've covered a little bit, or a lot of it already. Let's go over quickly, make sure I don't miss anything. Okay. Number 1. Home mortgages. I already explained, we call these properly residential mortgages. They go into single family and multifamily. Okay, let's see. Next, commercial. Mortgages are secured with commercial real estate. The third one is farm mortgage with secured with farming real estate. Next is actually 189, section 3. I already covered some. Okay, section number 3 will be mortgage characteristics. Again, I already covered. The size is highly customized, up to the needs, okay? Terms are highly customized. Let's see what else we got. Let's do this. I already covered primary mortgage market. Now we do secondary mortgage market. Is a market, is a financial market where mortgages are traded. In other words, already existing mortgages are bought and sold. The secondary mortgage market will have a few major buyers, okay? And these major buyers will try to standardize the mortgages. So they will have certain requirements. Okay, so they will, we say, partially standardize. So if the mortgage, we say, qualifies, to qualify means a number of things. To qualify means the following. You, meaning to satisfy certain criteria, satisfy certain requirement. So, you go to you're a borrower, you're a family, let's say you got married, well, you don't have to get married, you want to buy a house, you go to the bank for a mortgage loan, okay? And the bank will have certain requirements. To qualify for a loan means that you satisfy the bank's requirement for a mortgage loan, and the bank will, say, pre-approve you. To pre-approve. Pre-approve means the bank will, in general, let's say, approve you as a person based on your income, on your salary, on your jobs, on your experience, on your overall age. Maybe if you're 20 years old, they can approve you for a 30 years old. Sorry, for a 30 years loan. But if I'm 45 years old, they will approve me only for a 20-year loan. So they'll give you a pre-approval, and the key to a pre-approval is that they say you're pre-approved for up to 50,000 US dollars. You're pre-approved only for 25 because your income is lower, okay, and you don't have the job experience. So to pre-approve means they will give you only an initial approval for certain amount of money and for a certain period of time, okay? That's the pre-approval. Then, when you actually find the house, they will look at the house and say, okay, the house is worth 50,000. We will give you a loan of up to $40,000, okay? And from the pre-approval, after you find the property, with the property, you will get an approval, okay? So, when you qualify, you're able to borrow. Now, qualify, this is qualification on the primary market. Now, a mortgage can qualify for the secondary market. And if it qualifies for the secondary market, it means that it is relatively standard, as in it satisfies the criteria of the secondary mortgage market or the secondary mortgage market buyers. So, usually on the primary market, they will make the requirements exactly the same as on the secondary market. Which means that when the company issues the loan on the primary market, They'll take the loan and they'll immediately sell it on the secondary market, take the money and try to lend it again. Okay? So some of the lenders, and I'll be explaining this relatively soon, we call these mortgage company. Mortgage company is a financial institution which specializes in the issues or issuance of mortgages on the primary market. And then, here's the second key part, resells them to the secondary market. So all they do is issue mortgage, sell it. Issue mortgage, sell it. Somebody else holds the mortgage and collects the money on the mortgage. So probably what they'll do is the following. They'll issue a mortgage for $40,000 and then they'll sell the mortgage for $41,000 to the bank or to a mutual fund or whoever else will do it. Maybe they'll sell it to an investment bank and then the investment bank will securitize it. So mortgage companies will usually try to qualify and issue mortgages that qualify for the secondary market because they want to take the mortgage and sell it immediately. They don't want to hold the mortgage. Usually mortgages are held by commercial banks. Okay, so next characteristic I already clarified is called collateral. Collateral is an asset held as a security for a loan. If the loan is not paid, the asset is sold on the market, we say on the secondary market, and the money will be used to satisfy the loan. Collateral for mortgages is always real estate. Now, in a real estate, you'll have a brand new concept. It's illegal, it's very tricky, but most countries, most legal system in the world will have, maybe you'll need to open your dictionary. It's a difficult, tricky legal world. It's called a lien. Have you studied anywhere before? Lien. So you'll have to check to see if you have it in your law, a lien. So a lien is a legal claim on a property, usually recorded with the government. We call this office Recorder's Office. So when you borrow money from the bank will record a lien in the Recorder's Office. This means that if I want to buy a property, you want to sell me a house, I will look at the house, then I have to go to the Recorder's Office and see if somebody else has a claim or lien on the property. Maybe the bank will have, maybe your brother or your sister or somebody else will have a claim. So lien, anyone who has the house as a collateral will record the lien. And the lien could be, now it gets more complicated. First lien. First lien means that you're the first person who has a claim on the house, and if something goes wrong, you're the first person to get the house to satisfy your claim. Your claim is usually, you owe me money, you owe me $10,000, okay, for any reason. For example, when people get sick, okay, and in the West, let's say a medical operation, surgery could be horribly expensive, like A heart surgery could be $100,000, okay? Or even a basic surgery could be $10,000 or $20,000. The doctors will not operate on you. They'll say, hey, you can die, or if you want us to operate, you'll have to give us a mortgage or a lien on your house, okay? So you're dying there, you barely die, and they give you the paper, you sign to the hospital a mortgage or a lien, so that if you cannot pay within 3 months for the surgery, the hospital will take your house. Now, the hospital will immediately record the claim, okay? And maybe if you have a mortgage on your house, usually the mortgage company or the mortgage bank will have a first lien. So when you go to the hospital and say, look, doctor, I have a $100,000 house and I got a $50,000 mortgage. The doctor will say, no problem, I'll take a second lien. Second lien. Is a claim or a lien on a house, and here's the key word, subordinate to the first lien. Remember what subordinate means? Subordinate means that your claim is valid only after the senior claim is fully satisfied and you can keep the rest. So the house is worth $100,000, the bank has a first lien with your first claim for $50,000, and the doctor's got a second lien. You don't pay your doctor bill, the doctor will take the house, okay? He will sell the house. He must pay first the $50,000 first lien, and whatever is left, maybe he sold it for 96, he can keep the other 46 for himself. Okay? Again, this is getting a little bit of complicated law, but that's how things work, at least in the West, in a well-developed legal system. And of course, there may be a third lien. In other words, many people have many claims on the house, okay? Is it time to finish? All right, let's take a look at what else I got so I can finish. Okay, when I did before and explained the word free and clear, the complete term is called clear title. The word title means ownership, means legal ownership. So, property title means who owns the property. So, we say that I am on the title means I am the owner. Clear title means that there is no debt on the property. There is no lien on the property. And clear means that you have an exact number of owners and nobody else can claim the property. So if I own it, my brother has no legal claim to it. Okay? So that's a clear title. Now in Bulgaria, a son or a daughter cannot get a clear title unless all other brothers and sisters sign. Okay? So my dad can give the property to my brother, but my brother doesn't get a clear title. Because I can go to the court and say, hey, my father made an unfair division of property. I can go back and claim. Okay? So the title can be clear only after the court declares it to be clear. Okay, that's a very complicated stuff. Okay, So that was on collateral. We finished. Remind me next time we continue with more.